All right. Thank you for joining us tonight. I'm Shervin Joseph with Fitzgerald Financial, a division of TowneBank Mortgage. Alongside me is Sean Higgins, the Senior Vice President of United One Resources. We are going to do a presentation tonight, and this is the second part of a four-part series. Last week, we did Mortgage 101 and everything you want to know about credit. And because we feel that credit is so important, for the next three parts, including tonight, we're going to continue to run credit, everything you need to know about credit, and have the same situation, however, different questions, I'm sure. And I will do the grant programs available to first-time homebuyers and homebuyers around the Beltway this evening. However, I'm going to start with Sean Higgins is going to start us off. And Sean has been in the industry for over 30 years. He is the expert's expert, and I trust him implicitly on anything to do with credit and mortgages. Not to mention, he's just one of the true professionals in the industry. So without further ado, Sean, it's all yours.
Thanks, Shervin. Good evening, everyone. Shervin, thanks so much for having me today. I'm Sean Higgins from United One Resources. I'm based in Pennsylvania, just to give you a little flavor. Been at this business for 30 years now. And I just like to present a couple of things right up front. Number one is I'm not a credit repair agency. We actually work with lenders, and that's how we get access into the process. Our lenders work with homeowners, prospective homeowners, and we look to see where there's opportunities to present improvement in credit scores. So what I'm going to put up on the screen in a second is a presentation that gets through a lot of the information as it relates to credit reporting. My contact information will be right up front so that if there are any questions or anything that I can help you with either during or after the show, I'd be glad to. There's the ability to send messages through the chat is available, and Shervin and I look out for each other, and depending on who's presenting, we'll key in on the other person, let them know that there's a question, and we'll do our best to answer it. So if we could put my presentation up on the screen, I'll get started. So once again, Sean Higgins, United One Resources. I'm based in Wilkes-Barre, Pennsylvania, northeast part of the state. There's my email address, and there's my telephone number. And I'm going to get going right about now. So credit scoring. So we'll start with the basics. So what is credit scoring? Credit scoring is it's really the best way I describe it to people that ask me is it's a snapshot. So there's three credit reports that are out there on everyone with the three national credit reporting agencies, TransUnion, Experian, and Equifax. And the credit score will go ahead and present what's actually going on with that credit report right then and there at that time. So in this case, credit scores range from 300 to 850. The most popular model that we use in mortgage credit reporting is the Fico version 8. That's what Fannie Mae and Freddie Mac, who are the buyers of mortgages in the United States, use. I can get into a little bit of information on the differences between credit scores that are out there in the mainstream right now for everyone. So why is it important? When Shervin talks about the mortgage process, he's going to really spend a lot of time honing in on the credit score. It has a lot to do with pricing. It has a lot to do with approvability. There's ranges, and there's a whole lot that goes into it. So Shervin's presentation is very good as far as what the mortgage lender looks at in the credit reporting process. So the ranges, as I said, you could see there's some definitions that are put out there. It's 300 to 850. Anything above 700 is a very good credit score. There's also room for improvement all the time. The one thing we like to establish up front when we do these presentations is the credit score as it is right now isn't the credit score as it's going to be. There's ways to improve the credit score that we're going to talk about, and also let everybody know how they could actually go about it. The thing that I like to stress most when I'm doing these presentations is it has to start with a mortgage application. That's generally the best place to go. That's going to clear up a lot of misconceptions about what the score is, what the score can be, and also the approvability and all the things that Shervin's company will do in the process. But there's the ranges, 300 to 850. Anything above 800 is exceptional. We haven't seen a whole lot of people with 850 credit scores. They're out there, but they're very, very rare. The majority of what we see in our business are people that fall on the probably in the low 600s to 700 range. And once again, as I said, we're going to go through a lot of that as we get a little deeper in the presentation. So what actually impacts a credit score? There's a couple of different things out there that have a big impact on your credit score, and it's really your payments. So a credit report at its most basic being, or however you want to say it, a credit score at its most basic fact is it's a record of your payments. And payments obviously have the biggest impact on your credit score. The next part that's the biggest part of an impact on a credit score is your balances to your limits. You're going to hear us use a term called utilization. And really what that involves the revolving debt. If we could get those balances down to 20 or 30% of the available credit, it's going to have a very significant impact on the credit score. The length of the credit history, that's another big factor. Inquiries, not so much, and types of credit, not so much. So really what it comes down to is consistent on-time payments and working on that utilization of the revolving debt. Those are the biggest impacts on the credit score. What's an inquiry? So an inquiry is probably one of the most common questions that we get in credit scoring. Obviously, an inquiry is when you allow someone to have access to your credit report. They make a hard inquiry, and that is at your approval. So if you're in the mortgage application process, at some point, there's going to be a 1003 mortgage application put in front of you. And that's when you provide the authority to pull your credit report. When you actually look at your credit report, you can see who's made inquiries on it. And it's a pretty neat process to understand. But really, an inquiry is, at its most basic point, is the approval of someone to look at your credit report. A lot of people will ask, do inquiries have a lot to do with my credit score? And as you saw in the pie chart that I had up about 2 slides before, it's not a big factor. And really what FICO, FICO is an acronym for Fair Isaac Company. They're the scoring company that actually the credit bureaus work with. FICO has done some really neat things in the inquiry portion of credit reporting. What they've done is if you're shopping for a similar type of loan, whether it be a car loan, a home loan, whatever, those types of inquiries are sort of banded together inside of a 14-day period and treated as one. The other thing about credit inquiries to consider is FICO has a really neat statistic that they put out there. They said if someone has more than eight or greater inquiries on their credit report, it's an indicator that they may be headed towards bankruptcy. And the reason that they give us for that is because people are searching for a way out. So really, inquiries, use them judiciously. When you need something, obviously, that's the time to go ahead and have an inquiry made on your credit report. But if you're out there shopping for something, maybe a way out of a high balance or something like that, that's going to have a little bit of an impact on your credit score. Improving your score, obviously, a couple of basic common sense issues: pay your bills on time, keep your balances low. Those types of things are just really prudent common sense, and get into a little bit more detail on how you could actually improve your credit scores. But really, it's just, it's as I said before, it's the payment history, and it's also the utilization, 20 to 30%. So really, what drives your credit score down? Current rates, if you're late on a credit account, high balances on unsecured debt. So unsecured debt, revolving debt, credit cards, they're all the same. They're all terms that are used for interchangeably. If you have a balance that's pretty high against your available credit, that's going to have a little bit of a negative impact on your credit score. Unpaid public record information. And quite honestly, we've seen instances where someone that doesn't have a whole lot of open active trade, that's going to have a little bit of a negative impact on your score. How do you go about improving your credit score? So one of the biggest factors of a reduction in credit score is if you've had a recent late. And what we see is when we get engaged by our lenders to look to see if there's an opportunity to improve credit scores, we'll see maybe a recent late is having maybe a 50 or 60 point negative impact on a credit score. You'd be surprised if that was if that was truly a one-time instance, and you have a good relationship, which means a length of history with the account. You could pretty much call in and ask to have that late removed. And if it, as I said, if it has been a one-time occurrence and you've been a pretty good, consistent long-term customer, there's a good chance that that credit grantor is going to go ahead and remove that late. Collections are a big deal right now. There's a lot going on with collections. I'm going to talk about it a little bit more detail in a minute, but if you have a collection on your account and you have the ability to pay that collection account, you should always offer to pay it in exchange for removal on your credit report. Okay, that happens quite a bit. Collection agencies, they're salespeople. And if you go ahead and ask, you may get it. Revolving debt, anything below 30% is going to have a good impact on the credit score. Two other things that we see too in the scoring process is student loans. There's a lot of people have student loans right now. Student loans are, your payments are made through student loan servicers. And sometimes people have a deferment on their student loan. And quite honestly, we see a lot of times where the servicer is making mistakes. That negative situation that could arise out of that servicer not handling the payments or the deferment properly could have a negative impact on your score. That's one of the first things we look at when we're looking at a credit report to see if there's improvement. And usually those things can be straightened out pretty quick. But once again, you have to take a little bit of a pride of authorship in your credit report and find out what's actually happening. Installment loans, we always advise people it doesn't make a lot of sense to go out and pay off an installment loan sooner. A great example of an installment loan is a car loan. Say you have a 60-month car loan and you're supposed to pay $375 a month. If you decide you want to go ahead and pay that off sooner, it's not going to improve your credit score. That money is better used somewhere else in the process, maybe to reduce a balance on a revolving account or something like that. But installment loans being paid sooner really doesn't do a whole lot for the credit score. Okay, so everybody out there probably has heard of a Credit Karma account. Recent research has told me that 1 in every 3 people in the United States has a Credit Karma account. Credit Karma is great for a term that I like to use, which is credit fitness. There are differences, though. So Credit Karma uses a score called a Vantage score, which is the word advantage minus the AD, so it's Vantage. So it's a different scoring model. There are some similarities that the ranges are the same. There are some dissimilarities in the fact that Fico uses all 3 bureaus, whereas Credit Karma only uses Equifax and TransUnion. They do not use Experian. There's a mix of reasons that get pumped into the credit score calculation. You can see there's some differences there. And also the FICO score will not use rent or utility bills, whereas the Credit Karma score will. Here's the most important thing to remember. The Credit Karma score is going to be about 30 points higher than the FICO score. So if you remember the beginning of my presentation, I said it's the FICO 8. So the FICO 8 model is going to score 30 points less. And it's because of the black box that they sit in inside of each of these scoring models and actually go ahead and use for the calculation. So once again, Credit Karma, great for credit fitness, great to have a good understanding of what's going on with your credit report. However, it's going to be about 30 points higher than what the mortgage score is. That's very, very important to know when you're applying for credit. It's going to come up. Experian Boost, that's another product that's out in the mainstream right now. Straight out, right up front, Experian Boost does not improve a credit score for mortgages. Actually, when an Experian Boost account gets appended to a credit file, which is an Experian-only file, the FICO 8 score does not look at that as part of the calculation. Examples of how Experian Boost makes its way on your credit report is it's going to show up as a self-reported utility or a cell phone. We've even seen Netflix $15 accounts report on an Experian file. It can get into an issue when you're going for a mortgage because there's some balances that have to be considered in calculations. Experian Boost does serve a purpose. The best place for Experian Boost is for people that are trying to build credit you may be using it to go ahead and get a utility account or a cell phone or some other utility, but it's not a part of the credit score that's used in mortgage. If it does become a factor in the process for the mortgage, we advise consumers just to log on to their Experian Boost account and opt out, and it will fall right off the credit report. So rental information. Before I was a homeowner, I was a renter, and rental information is good credit information. However, it is being considered as part of the mortgage process with the Fannie Mae approvals starting about a little bit over a year ago. However, rental payments are not considered part of the credit score. So there's a little bit of a misnomer out there that you can improve your credit score through your rental payments. And that's just not true, because they're not considered in the credit scoring process. This is what I was referring to before about medical collections in particular. So if you have a medical collection account, say you owe $87 to your dentist or $155 to your ambulance provider, something like that, and that was paid, a lot of times the collection agency would not remove that trade line. And that would cost consumers 60 to 100 points on their credit score. So effective this past July 1st, a paid medical collection debt was no longer allowed to be considered on a consumer's credit report. Also on July 1st, the period of time to report an unpaid medical collection debt on the credit report was extended to 1 year from 6 months. And even better, in the first half of 2023, any medical collection account that's below $500 is not going to be reported on the credit report going forward. I have a good friend in the collections business in Pennsylvania, and he said he lost a big hammer because of this. And quite honestly, my response was, it probably shouldn't have been on a consumer's credit report anyway, because there's certain facts and circumstances that create those accounts, and someone shouldn't be punished by as much as 60 to 100 points on their credit report because of that, and have a negative impact on their credit score and also a higher cost of borrowing because of it. That's great news for the consumer, and that just came out recently. So as far as getting a good handle on what's going on with your credit report, there's the contact information for the 3 credit reporting agencies, Experian, Equifax, and TransUnion. Annualcreditreport.com is a website. Every consumer in the United States is entitled to a copy of their consumer credit report every week, because we're considered still to be impacted by COVID, and that's still available to consumers every week for free. It's a little bit of a challenge when you get onto the system. You have to know some challenge questions about your past, like where did you live in this year, and did you have a car loan, for which bank was it, and those types of things. So once in a while, that's just a little bit. It's a great idea to get a copy of your annual credit report and monitor it. And the final website that I put up is optoutprescreen.com. And what we found is America's been opted in to pre-approved offers of credit for insurance and credit cards and loans. That presents a problem in the fact that your information could be sitting in a mailbox and you may not be aware of it, and the bad guys can get their hands on it. So I advise consumers to opt out pre-screen, and that does not prevent you from shopping for credit in the mortgage application process, hopefully with a great lender like Shervin. But opt-out pre-screen is something that you should take a hard look at and see if you can have your information suppressed so that you're not at risk for identity theft or anything else bad that can happen with it, because there's great opportunities to get access to your credit, and it should be at your direction as opposed to being decided for you. Shervin, that's really all I have for today. And once again, I'm glad to answer any questions that may come up in the process. Some good information available to consumers. The thing I like to leave everybody with is, A, we're not a credit repair agency, and then B, you really should take an interest in your credit information. It's available, and credit fitness is a great thing. Thank you.
Thanks, Sean. As always, just an amazing job. I think just to reiterate what Sean was saying with regards to the credit repair piece, and to make it perfectly clear, again, he's not credit repair. We're not sitting here telling you that we won't assist you in the direction of doing a rescore or anything like that. But we're not a credit repair agency or any of these shysters that are looking to take you for a couple $1,000 on something that you could do yourself. You know, the fact is that usually when it comes time to lowering debt or paying debt off, this is something that you could take care of on your own. And we could assist you, because the great thing with Sean's company, they have a credit simulator. And we use the credit simulator. So if your credit score happens to be below par, we could assess where you are. We could tell you exactly what the credit simulator is advising us. In other words, what accounts to pay down, what accounts to pay off, what charge-offs might be prohibiting you from increasing your score, what collections are there that need to be resolved. And so those are all items that we could assist you with. Now, when it comes time to paying off the debts and so forth, or settling the debts, you don't have to pay them in full. That's something you have to discuss with the creditor. Okay, we don't get involved in that. But again, that is something some of these credit repair companies are going to charge you $1,000, $2,000 plus, and it goes on. That's the money that you could use to pay down your debt. That's the money that you could use to close your loan and you know, be a homeowner. So don't go blindly because these credit repairers feel that you're under the gun and stressed because you want to get your credit in order, but you feel that this is your only option. No, go in, get pre-qualified, pre-approved, see if you can get pre-approved. And at that point, depending on the loan officer, work with one that has integrity. Just like I believe in Sean, who has the highest integrity. Hopefully you give me a call. I'll be more than happy to walk you through it. But even if it's not me and you have a lender in mind, make sure they're credible and they're going to lead you down the right path and then give you accurate information. That is absolutely critical. And you're not going to a credit repair person to do something that makes absolutely no sense. So just be careful. I just wanted to reiterate what Sean was saying with regards to the credit repair piece. So I'm going to pull up my presentation now. And last week, as I said, we did Mortgage 101. Now I'm with Fitzgerald Financial Group. We're a division of TowneBank Mortgage. TowneBank, at the beginning of this year, we were blessed with Forbes magazine naming us, out of about 5,000 banks in this country, number 9th performing bank in the United States, which we treasure and we cherish the fact that we were blessed to be that, higher number. The good thing is a lot of hard work with a lot of folks at TowneBank Mortgage put us in that situation. Fitzgerald Financial, which is a division of TowneBank, and everybody knows us around the Beltway, down the East Coast and so forth. We do loans, contact me and I'll let you know if you need a loan in Ohio, in Tennessee, in Alabama, in Florida, Georgia. We're capable of doing loans there as well. So as I was saying before, I've been in the business 36 years. I've held every management position in the mortgage division. Right now, I am a diversity outreach manager, and I'll always be a mortgage loan officer. So I am doing loans and so forth. It's critical that for me, that I stay engaged with everything going on in the industry. Right now we still have a crisis, in my opinion, that home ownership gap is currently 75% for white Americans and 44% for Black Americans, according to the U.S. Census Bureau. And I think it is absolutely critical that we do everything in our power to ensure that we close that gap. Because I'm just a big believer that every American, whether you're red, black, brown, white, whatever your religion, needs to have the opportunity to home ownership. And the way we do that is making you aware of the process through literacy and, you asking questions. So that's why we're here for you. And you're welcome to call me at any time, and I will assist you to ensure that you get to your destination, which is to be a homeowner. So last week we did Mortgage 101, and this week we are doing the grant programs. And I felt that we did enough last week to give you a picture of where to go in case you're either a first-time home buyer, and in some cases they allow other buyers to be able to use funds too. So while I'm covering grant funds, keep in mind there's only so much time we have to go over everything. So with grant funds, you have to not only qualify for the mortgage loan, whether it's FHA, conventional, or VA, then you have to qualify for whoever the entity is given the grant, their guidelines. So once we get an approval, then we will send your loan to the grant funds. But prior to that, you need to know whether or not you will qualify for those funds. So the first one I want to discuss is the MMP, which is the Maryland Mortgage Program. And the Maryland Mortgage Program is known, what I like to think that it's known, it's really an excellent program. It's the First Time Advantage program, and I've used it for years. We've managed to assist just a number of folks to get in. Now, keep in mind, a grant program, you might have funds to get you to a certain point, but you need a little extra to pay for your closing, to help you with your down payment. And that's why it's called down payment assistance and closing cost assistance. So the eligible for first-time home buyers in this particular program, and this particular program allows qualified first-time buyers up to 3, 4, or 5% of the loan amount that they could use towards, as I said, down payment and closing costs. The interest rates on the first mortgage on this particular mortgage is deferred. It's no interest second loan equal to the 3, 4, 5% of the first mortgage. If the funds exceed the down payment and closing costs, then the remainder can be applied to your principal balance. The second loan is paid off when the loan is refinanced or sold at zero interest. Now, eligible borrowers must qualify for the MMP loan. For example, income limitations, credit score, and purchase price limits. Additional requirements may apply. Now, with all of that said, we have to look at their guidelines. And, when you're looking to try and get in a home and you have X amount of dollars, the first thing we do is to see if you qualify for a home. That's the first thing. Make sure that your debt ratio is in play and your credit score is in play. Then when we look at your assets for funds to close, we see if and how, which part of the first time advantage was the 3, 4, 5% is needed. And there are income limitations because it's either the area median income is either 80%, 50%, and so forth. So again, I'm not going to go into that detail because when you cut through it, we have to go on a case-by-case basis to see how people qualify. And it is absolutely critical that once we get you approved in-house, that we then have to electronically, because we've had a relationship with the Maryland Mortgage Program for a number of years. So we do everything electronically. And so this doesn't take much time at all. Matter of fact, there was a time, as I said, I've been in the business 36 years. there was a time when you had to carry your package to the Maryland Mortgage Program's headquarters. So now we do everything electronically, and we could close these loans in less than a month. Absolutely less than 30 days, we could close your loan. And again, keep in mind that the Maryland Mortgage Program, have their own rates. So this isn't locked under our rates. This is locked in under the program's rates. So that's something to keep in mind. And again, their rates are going to be a little higher than our rates, but that's on a daily basis. And that is something we have to look at when you come in and pre-qualify. And we can't do anything with this program, or for that matter, with any program, without a ratified contract. The next program, and keep in mind, there are a number of Maryland mortgage programs. I'm just highlighting a couple of them for you right now. And the Maryland mortgage programs, First Time Advantage 6,000. So the First Time Advantage 6,000 offers qualified buyers up to 6,000 towards down payment and closing costs. Offers a low interest rate on the first mortgage and a deferred no interest second loan equal to 6,000. If the funds exceed down payment and closing costs, then the remainder can be applied to the principal as the previous product that I just discussed. The second loan is paid off when the loan is refinanced or sold at zero interest. Eligible borrowers must qualify for an MMP loan. For example, income limitations, credit score, purchase price limits, etc. Keep in mind, all these programs are going to have the same tone with regards to the guidelines: credit score, purchase limits, and income limitations. And so it's critical that we make sure that we get everything right so you know what to use. But when you come into pre-qualify, we'll assess where you are from a pre-qualification standpoint, and then we'll assess whether or not you will qualify for a program. Again, we cannot go in and reserve any funds for you. The great thing about this program with MMP, which is the Maryland Mortgage Program, is that we could go in and reserve funds once we have a ratified contract. Absolutely critical. Once we have a ratified contract, we could reserve funds for you, and they will allot us a time to get this closed by, which we are usually getting loan closed well before their time frame. So you have nothing to worry about there as long as you qualify for the mortgage. Now, the Home Start 6% down payment assistance loan. The Maryland Mortgage Home Start offers qualified first-time home buyers up to 6% towards down payment and closing costs. Now, it's similar to the other programs, except the median income on this is lower. So we really have to watch what your income is and the income limitations on this particular program. We have to keep a close eye on your qualifications. Again, offers a competitive interest rate on the first mortgage and a deferred. No interest second loan equal to 6% for the first mortgage. If funds exceed down payment and closing costs, then the remainder can be applied to the principal. This is great, because then on all their products, you're getting the opportunity to utilize the funds given to you. It's not going back to MMP. It's actually used to lower your principal balance. The second loan is paid off when the loan is refinanced or sold at zero interest. Eligible borrowers must qualify for MMP. For example, income limitations, credit score, purchase price limits, additional requirements apply. So just in the last few minutes, just in about 15 minutes, I've given you 3 products that you could use that's given you 3%, 4%, 6%, $6,000 towards down payment and closing costs if you qualify. And again, the $6,000 down payment assistance loan program, they also will hold the rate. They will give us the rate for us to lock you in at. That is not our, that is out of our control. That's totally up to the MMP. All right. Now, moving right along, if you're looking to buy in DC, there's the DC Open Doors program. Now, DC Open Doors offers you a variety of mortgage products, including down payment assistance loans, which obviously make home ownership affordable in the district. It's a zero down loan up to 100% financing. In other words, they're going to give you quite a large sum to where hopefully you don't have to come out of pocket. Now, there's no first-time home buyer requirement on the DC Open Doors situation. The maximum debt to income ratio is 50%. 50. On an FHA loan is 45, unless credit score is 680. So let me repeat that. The maximum debt to income ratio is 50%. And an FHA loan is 45%. And FHA is usually a little milder and a little less strict, to give you a little bit more latitude. But on this product, and just to go back to the MMP, they're the same way. Maximum FHA DTI is 45%. And in this case, unless your credit score is 680. Okay. With regards to MMP, their credit score is 620. And depending on the product, we would have to see where your credit score is and if you qualify, whether it's 620 or 640. In this particular case, it's 680 for the DC Open Doors. Loan amounts are up to $647,200. So understand, loan amounts again are up to $647,200. Maximum borrower income is $154,800. So it cannot exceed $154,800. And of course, conventional and FHA loan programs are available. And it's a great program, as you could see. But again, we have to make sure you qualify, make sure the credit scores are in play, and so forth. Next, first home loan bank grant options. Down payment option for every home buyer. It's a first-time home buyers program. You could get up to $7,500 in assistance for closing costs, down payment with a minimum contribution of $1,000 from the borrower. So the borrower has to contribute at least $1,000 on this particular program. But you must be a first-time home buyer, and it must be owner-occupied. Okay? Community partners, current or retired law enforcement officers, firefighters, employees of state-accredited schools, employees of healthcare systems, fire responders, active duty military members, veterans and their surviving spouses, and COVID-related essential workers could receive up to $10,000 towards their down payment and closing costs on their home loan. The same requirements would apply. So, to as far as qualifying. So we would have to look at the qualifications and make sure you qualify. But just to reiterate, this is a first-time home buyer program, whether it's for the first-time home buyer that is not affiliated as a community partner, which will get $7,500, but the community partners first-time home buyer program will allow for $10,000. Another excellent program. Now, Virginia Housing first-time home buyer down payment assistance grant programs used with FHA loans. The terms are maximum grant of 2.5% of the purchase price. Minimum credit score is 620. Maximum debt to income ratio is 45%. Now, grant funds have no repayment and can be paired with a mortgage credit certificate, the MCC. Requirements eligible for first-time home buyers. Grant funds must be used with eligible Virginia housing loan. Income and sales price limits apply. Eligible Virginia housing mortgage must be locked prior to reserving grant funds. Primary residence only. When they say primary residence only, they mean owner occupied only. Okay. This is another good program for the state of Virginia. Another program in the state of Virginia, but this is the same Virginia Housing First-Time Homebuyer Down Payment Assistance Grants used with conventional loans. The terms maximum is 2% of the purchase price. Minimum credit score is 640. Maximum DTI, that's your debt to income ratio, is 45%. Grant funds have no repayment, can be paired with a mortgage credit certificate. Requirements eligible for first-time home buyers. Grant funds must be used with eligible Virginia housing loan. Income and sales price limits apply. Eligible Virginia housing mortgage must be locked prior to reserving grant funds. Again, primary residence, owner occupied residence only. Another Virginia housing for VA and USDA loans. Maximum grant is 2% of the purchase price. Minimum credit score is 620. Maximum debt to income ratio is 45%. Grant funds can be applied to your closing costs for rural guarantee or VA funding fee. Grant funds have no repayment, can be paired with a mortgage credit certificate. Requirements eligible for first-time home buyers. Grant funds must be used with eligible Virginia housing loan. Income and sales price limits apply. Eligible Virginia housing mortgage must be locked prior to reserving grant funds. Again, primary residence only owner occupied. So when we're done with the grant programs, and at the end of my presentation, I always like to give you the home buying don'ts. Number one, and this is while you're going through the process for the mortgage, do not change jobs, become self-employed, or quit your job. Number two, do not buy a car, truck, or van. Number three, do not use charge cards excessively or let your accounts fall behind. Number four, do not spend money you have set aside for closing. Okay, the reason I conclude with these home buying don'ts, because these are known abuses, and it just prohibits you from getting a mortgage. I've seen it time and time again where folks think everything is hunky-dory and they go out and they do these don'ts. And that's why I am emphatic and passionate to make sure that you understand the process. Number five, do not omit debts or liabilities from your loan application. Number six, do not buy furniture. Number seven, do not originate any inquiries on your credit card. Number eight, do not make large deposits without first checking with your loan officer. Number nine, do not change bank accounts or move money between accounts. And number 10, do not co-sign a loan for anyone. Now, everyone thinks because they've made their credit report and everything that is in process that they could go and charge up everything, charge on their accounts, and they could move money around and so forth. Anytime you make a charge, just about every lender will run a soft pull to make sure your credit is in the same state that it was at the time of application. In other words, we don't want to see any inquiries or new debt on there, because then we have to requalify you, and you might not qualify. Okay. Any large deposits in your bank account, we have to do a paper trail. So we need an explanation and supporting documentation for this information. So it's absolutely critical that you just adhere to the don'ts. And if in doubt, just check with your loan officer. Now, if your loan officer is me, I'm going to give you a lecture on everything. And if there's something you did, I'm going to tell you exactly what needs to be done, what support documentation we need to see if everything is still okay. But it all starts with a conversation. The best way is just not to fall prey to the home buying don'ts. Just keep everything as clean as possible until you get your keys. So that's it for me. My information is right here. Again, Shervin Joseph. Phone number is 571-278-8351. I could be reached at shervin.joseph@fitzgeraldfinancial.net. And I thank you guys for attending. If you have any questions, please feel free to ask your questions now, or you're welcome to contact myself or Sean with any questions you have, and we'll be glad to take care of it. If not, we thank you for attending, and we look forward to seeing you in the future so we could assist you with your path to home ownership. Thank you.
Thank you.